Today is Monday, November 17th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the grains this morning, Mark, anything stand out as surprising in Friday's USDA updates?
Well, to me, the biggest surprise in corn was the USDA keeping their feed usage forecast unchanged at a lofty 6.1 billion bushels. This as U.S. cattle inventories have been slow to build with the screwworm problem in Mexico. Leading up to the government shutdown, cattle on feed had been running about 1% to 2% below year-ago levels. Pretty much all year, while placements had fallen to only 90% of year-ago levels, that with the last reporting month before the shutdown, that in August. The USDA did cut their old crop feed usage forecast 183 million bushels to just under 5.5 billion. So to me, it would seem a stretch that the USDA new crop usage numbers at 6.1 billion, that's 10% over last year. That would seem to be a little bit of a stretch. On the production side of the equation, the USDA did trim their August yield, or their average yield forecast, 0.7 bushels an acre to 186, still a record high. Production at 16.752 billion. That was still nearly 200 million bushels above the average trade guess. So to me, for prices to get back up to or above that 450 level, I think we're going to need to see final yields much closer to 180 bushels an acre, enabling stocks to draw back down under 2 billion. But ironically, that's pretty much exactly what we saw last year when production in January was slashed to 275 million bushels. So we still have some uncertainty there. On soybeans, both production and stocks, they were slightly below expectations, while on the demand side of the equation, the USDA seemingly taking a measured approach here to their export forecast. They did cut it 50 million bushels to 1.635 billion, given the lack of sales to date to China. However, several still think that's could be another 100, 200 million bushels too high, and that forecast's already sitting at a 22-year low. So while the Trump administration continues to maintain China will buy U.S. beans in bulk, so far the evidence is lacking, and U.S. prices are really kind of uncompetitive in the global marketplace versus what's being offered out of Brazil. And as we sit with a 10% tariff differential that works against us.
And Mark, with the federal government now back open, what data will you most be focused on?
Well, first and foremost, we'll be glued to any evidence of soybean sales to China or unknown. The updated flash sales revealed by the USDA also on Friday showed that during the government shutdown, we did sell 332,000 tons of beans to China, another 616,000 to unknown buyers. But you combine those, it's still under 1 million metric tons, which is basically 1/12 of what the Trump administration has been touting China would buy before the end of the year. That message seems to be changing a little bit over the weekend, as now they're suggesting the sales volume to China would occur before the end of the 25-26 marketing year. So the market seems to be taking this message as gospel, with prices right now surging in the new highs this morning. I will add, however, that current projections by the USDA do show global stocks among major exporting countries just under 19%, which would be the lowest in about 10 to 12 years. Other thing I'll be looking for is the CFTC data. Still no schedule out yet on when they will start updating the commitment of traders data, but I suspect we're going to see a pretty significant shift. Funds now holding a pretty massive net long position in beans, over 100,000 contracts, I would think, after today's activity, and that would be the largest in over 2.5 years.
Thanks, Mark. JP, let's look at the financials. Is September's labor report going to be a big deal for the markets?
It's hard to say how much September's labor report is going to affect markets, but I think it will certainly serve as a confirmation of belief for either the doves or the hawks, depending on what the data tells us. I can certainly see a scenario where the report comes in weak, reflecting what has been a continued weakness in the labor market, offering doves in the FOMC an opportunity to press ahead with calls for a December rate cut, while on the other side of the camp, the hawks could argue that with the data being 2 months delayed, it should not be emphasized with too much importance. On the other hand, a stronger reading could reinforce views that labor market remains stable, and that gives time the Fed to continue to move to bring inflation down. It's still well above their 2% target. And Doves could counter that, saying, with the report being so old and recent news of an uptick in layoffs from large corporations, the Fed should continue to move to cut rates. It should be noted, too, that September was the month where many federal workers were expected to come off payroll after taking a deferred resignation. However, those payrolls would have ended on September 30th, so it could also be likely that those individuals would not have been seen on September's labor report and instead would show up on October's report, which, as we all know, will likely be skipped. In a nutshell, I think it is important to pay attention to September's labor report, especially now that odds of a December rate cut are almost close to a 50-50 toss-up. We're seeing them dip around closer to 40% today. But I think if markets weren't almost evenly split on December's Fed meeting, I would say that a report over 2 months old would not garner too much attention. But given the context, markets will certainly look to it for clues on how the Fed will move in December.
All right, JP, and why have investors scaled back on bets of a December rate cut?
Yeah, there's been multiple reasons why odds of a December rate cut have been scaled back recently. In the data fog of the U.S. government shutdown, markets were forced to look at private figures, which offered mixed signals about the labor market. However, one thing that was available to markets was public comments from Fed officials regarding their opinions on how the Fed should move come December. Now, those comments were mixed, but I think a lot of policymakers did offer cautious remarks, which in turn led markets to reduce bets of a December rate cut. Several Fed officials voiced concerns over cutting rates too quickly, especially given that inflation is still resting above target. Notably, too, is that services sector inflation is a huge concern for policymakers, and ISM PMI data had showed an elevated services sector prices, offering further concern for officials at the FOMC who are still very adamant and worried about inflation. On the other hand, there were the typical doves, Waller and Bowman, for instance, who continue to voice support for another cut, while Moran voiced his support for a 50 basis point rate cut. But markets were already largely expecting those officials to be voicing support for a rate cut in December. Now, the private data regarding the labor market has been mixed. Markets are looking ahead to Thursday's release of September's report, which, like I'd mentioned earlier, could have the potential to sway opinion at the FOMC. However, I think it's likely that those officials will likely mostly be set in their ways. Fed funds futures are pricing in just under a 42% chance of a December cut, suggesting that markets have been listening to the hawks and anticipate that, given the mixed economic signals, the Fed may want to wait until fresh data on the economy is available before the bank moves to make a decision.
We'll see. Have to see what they do there. Mark Bowman, can you explain what is a sudden stratospheric warning and what it has to do with natural gas?
Okay, yeah. Well, this sudden stratospheric warning seems to be the topic of the moment, and that's when the stratosphere above the North Pole suddenly warms, and this usually leads to a disruption in the jet stream instability and the polar vortex, which allows massive cold air to move down southward into North America and sometimes into Europe. Sometimes it goes all the way to Texas and Florida. Now, this current one is expected to hit around the beginning of December. Our weather service, World Weather Inc., says it's a bit too soon to predict how cold it will be, but they also are predicting the next wave of cold weather to reach the United States in the first week of December. And that only reinforces this other forecast. They also have a colder bias for this winter, partially due to this aspect and due to the lunar cycle data. And anyway, that cold weather, of course, could take a currently somewhat slightly burdensome U.S. supply and turn it into a deficit and lift natural gas prices.
And lastly, Mark, what did the supply-demand report tell us about the cotton situation?
So U.S. and world production and ending stocks all came in above expectations. U.S. cotton production at 14.12 million bales versus something around 13.5 million expected and 13.22 million in the September update. So that's an increase of 900,000 bales. Likewise, ending stocks up to 4.3 million from 3.6 million in September, an increase of 700,000 bales. And that puts the stock to use ratio at 30.9% versus 26.3% in September. And this is the highest since 22-23. Likewise, world production up 2.4 million bales to 120.8 million. And they not only increased U.S. production, they raised China's production by 1 million bales and Brazil's by 500,000. So this takes world ending stocks up another 2.79 million bales, and that ratio there 63.9%, the highest since 22-23. Now, we already have a market hovering around 5-year lows and not that far from 15-year lows. So it's not like there's a big sudden change in the outlook. But I would say the best thing the bulls can hope for at this point is either for a resurgence in export sales to show up in the export sales reports, which will be, we've got several weeks to get caught up on, and they're going to be released at somewhat accelerated pace over the next few weeks to try to catch up. And the other thing may be a lack of follow through on the downside.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.